The first item I want to look at today in the Wiley Plus is brief exercise 3-5. With 3-5, and we will also look at brief exercise 3-6. With this example, we're going to look at nearly the same problem. It's going to have the same type of company names with maybe just a different number value, but we're going to look at the same problem from two different perspectives. We're going to look at it on 3-5 from the perspective of the customer, and on 3-6, we're going to look at it from the perspective of the supplier, whoever the supplier may be. In this case, it's an insurance provider. So with brief exercise 3-5, we have on the 1st of July, this company pays $13,000 to the insurance company for a 3-year contract. Both companies have a fiscal year end of December 31, so that's when their cutoff is. And so they want us to do the first journal entry here on July 1, and this is looking at it from the perspective it tells us of the Dobbs company, or the customer in this case. So we've got to think, what did the Dobbs company get on July 1? Well, they got the benefit of 3 years of insurance, so we call that prepaid insurance. It's our debit, $13,800. And then the credit question, how did they get the prepaid insurance? Well, they paid cash. Now we need to come down and do the adjusting entry on December 31, because as of the end of the year, some of that prepaid insurance has now been used. The company has benefited from the insurance. And so whenever there's a benefit, we know that automatically is an expense, or typically it's an expense as long as it meets our two questions. Am I using that benefit right now? And the answer is yes, I'm using the insurance this year or this month, whatever it may be. And is this benefit only good for this year? And the answer again is yes, whereas something like equipment is good for more than just 1 year. So that's why equipment is an expense. It's an asset. So back to this one, we're going to show that we have insurance expense. But then the key here is to show how much insurance expense is there. Well, for this one, it's going to help if I bring up a calculator, and I don't see one right here that I can bring up and show on the screen. No. So I'm going to bring up a calculator off to the side. And what we want to do is take this $13,800 and divide it over 3 years. So that gave me $4,600 a year. But we only used it a half a year. It goes from July to December. So I want to take that $4,600 and divide it by 2. So I really only used $2,300 of that insurance. And so that's what I want to show is being used, and then what I want to take away from my prepaid insurance. Now, when we get down here to this is the T account port, and this is very simple. It's making sure you know what to do here. With the prepaid insurance, we had a debit of $13,800. We had a credit to prepaid insurance on 12/31 of $2,300. And so the final thing that I need to do is show what the balance is at the end of the year. So taking the $13,800 minus $2,300, and I believe we'll get $11,500. And notice I don't need to put anything over here because that's the normal balance would be on the debit side. And the insurance expense was on December 31 for the $2,300. Notice they didn't even ask us to provide the cash. Okay, let's look at brief exercise 3-6. Notice we have the same company, Dobbs, and the same insurance company. The number just is a little different, but that's not going to be an issue. But this time we're going to look at it from the insurance company's perspective, so the supplier of the insurance. So on July 1, what did the insurance company get? Well, they got paid. They got their cash of $17,700. And then we got to ask the question, why did they get the cash? And immediately you might think, well, because they provided a service. But that's not quite true, because on July 1, they haven't provided a service yet. That's a service for the next 3 years. That's payment for the next 3 years. So we call that unearned revenue. And this this case, unearned service revenue. And then come December 31, I've now used some of that unearned revenue. It's now, I'm not used, but I've actually earned it. So unearned service revenue, and again, I want to pull up my calculator. I want to divide the 17.7 equally over 3 years. And then, since I'm only using it for a half of one of those years, I need to divide that, what I just got, which was 5,900, and divide it by 2, and I got 2,950. And that 2,950, if it's no longer unearned service revenue, it is called service revenue. And then the T accounts would work just like what we did with brief exercise 3-6 or 3-5. The next question I wanted to look at was exercise 3-5. Because with this one, there's a few things that we hadn't talked about in class. But first off, what they've given us is just some select balances from T accounts. So off to the side, if you want to jot down and in the accounting equation some of these balances, it may help you. But these are not all the balances by any means. So if you were to do to see if your equation balanced with these balances here, it's not going to. So don't check your balances when you're all done on this problem, especially when we only give you, as it says here, selected amounts. It's not the whole amounts for the entire business. The first one I wanted to go through here was when interest is accruing. So this company borrowed $10,200 on a note, and we see that here as one of the balances given to us. And all of it is due plus interest in 1 year. Now, we took out the loan in September. It's now December, the end of December. So 4 months has gone by where interest has been accruing. Now, I haven't paid any of it, and I haven't paid on any of the note yet. But just like with my wages, if an employee works for me, even though I may not pay him by the end of the year, I still have to show that work has been done, like a wage expense, and then credit a wage payable. Same thing here. But what I need to do is figure out how much interest has accrued since the issuance of the note. And to do interest, you need to remember back to math days when you were in math class and what the interest formula is. And remember, it's I interest equals PRT, which stands for principal times rate times time. And time is always in years. So I pulled up the calculator off to the side again, and I want to simply do that formula. So my principal, $10,200, times my rate, 12%, so 0.2 is a decimal. Now, the key part here, times time. And I don't want to use 1 year because it hasn't been a year. It's only been a partial amount of a year. In this case, it's only been 4 months out of 12. 4 out of 12, which equals a third. So I can multiply this by 4 divided by 12, or 0.33, however it helps for your calculation or your calculator. And our answer is going to be $408. That's how much interest has accrued since the beginning of this note. So whenever there's interest involved, and if we have to end up paying it at some point, that's an expense. We got the benefit of having that note of borrowing money. So we owe, at this point in the year, $408 in interest, even though I haven't paid it yet. So my credit will be that I owe that money, which is a liability, and we're going to call that interest payable for 408. Number 2, you should be able to do that from based on what we have done in class and some of the previous examples that I have posted here on the videos of YouTube videos. If we only have 860 left and we started with 2,300, you need to figure out how much supplies we've used. This one, they go ahead and just tell us the depreciation. No need to even figure it out. Number 4, got to pay careful attention here to the dates. We paid $4,000 for insurance, and this insurance started on June 1, and we're now in December. Okay, so we look up here, and sure enough, here's my prepaid insurance T account. Well, a lot of that $4,000 is no longer prepaid. I've now used some of that insurance. So I'm going to come down here to number 4, and when the company gets a benefit of something, that's an expense. In this case, it's insurance expense. And I want to get out my calculator again, and I want to see how much of this $4,000 I've actually used. So I want to take the $4,000 and divide it evenly over a year, since it's a year, 12-month contract. So 4,020 divided by 12 gives me $335 a month. And then I simply need to count how many months have I used this insurance. And there's no need to try to be quick and cute here. Actually count it out if you need to. June, July, August, September, October, November, December. I've used it 7 months. So take that 335 times 7. I need to show an adjusting entry of 2345 as insurance being used. And then corresponding that amount coming out of my prepaid insurance. I'll go through one more, because a lot of these have dates involved. Let's look at, this one here. Notice this one's in December, and it goes through, let's go ahead and look at this one. On December 1, so this is right towards the end of the year now, we went ahead and got money for $32,800 for services to be done later. So I've got to think, what was the entry back on December 1? Well, what did the business get? They would have gotten cash for $32,800. They gotten cash for a job that's not yet completed. So they would have called that unearned revenue for $32,800. Now it's 1 month out of the 4 of the 4 months has been completed. So 25% of this work has now been completed, and I want to show that as of the end of December. So what did the business get? We got a reduction on what we owe as a service. We had unearned service revenue of $32,800, but now I've used some of that, and I want to reduce it. So I want to take this $32,800 and divide it equally over the 4 months. And that comes up to $8,200 per month. So after 1 month, I have earned, supposedly, as long as everything still is on time, I've earned $8,200, and I can actually call that now service revenue. So there's hopefully some help on how you're going to go about completing exercise 3-5. When you get to exercise 4-12, this has to do with correcting entries. And the correcting entries are put into 2 parts. And if you go back to my videos, I explain both of these parts, option 1 and option 2. And Wiley Plus here wants you to do both option 1 and option 2. Option 1 and option 2 being my words. Option 1 is simply doing kind of the easier way, but it has more entries involved, so it takes a little bit longer. It's a little bit more repetitive. But still, I think it's the easiest if you have trouble comprehending some of this. Just stick to this easier way. So let's look at number 1 and do that one. A payment of salaries and wages expense of $800 was debited to equipment and credited cash. Okay, so the actual entry should have been a debit to salary and wage expense and credit to cash, when they went ahead and debited it to equipment and credit cash. So they got the cash right, but just not the equipment. So the first thing that if we do option number 1 is simply to reverse the entry and then show the correct entry. So the reverse to this entry is, since they debited equipment and credited cash, we want to do the reverse. So we want to debit our cash, $800, and credit the equipment for $800. That zeroes it out. That's like the transaction never happened. Everything's back to where it was. Now we want to do the actual journal entry. So we would debit our expense account, salary and wages expense for $800, which is what it always should have been, and then credit the cash. So the cash, we originally took it back out of $800 now, or put it back in for $800. Now we're taking it back out. That's kind of the repetitive part. This cash, this credit to cash of 800 and this debit to cash of 800 basically cancel each other out. So that's what they get. That's what Wiley Plus here is getting to as option 2. If you know that your debit and credit on one of your transactions will cancel each other out, you can simply just do one entry with the 2 items that don't cancel each other out, which would be these 2. So basically what's happening here is when we debited our equipment was too high. We didn't actually get another $800 of equipment, so I need to remove it. Therefore, I need to credit my equipment. But instead of the equipment, it should have been a debit to the wages expense. And nowhere was there a debit to wages expense. So my wages expense was too low. So I need to show a debit to get my expense up to where it needed to be originally. And that's what they're wanting us to that's what they're wanting you to show here in part 2, is to say, okay, you can do it option 1 way, where you do a reverse and then do the correct entry, or now you don't do both, or you do option 2 and just show that, okay, the entry should have been a debit to wages and salary expense for 800, and the equipment should not have been debited, so we need to remove that 800 that was originally there. That's how you're going to want to go about and do exercise 4-12. The last thing that I wanted to show you is just briefly on 3-7, exercise 3-7. What this is the key part to remember. It's always easy to assume that most examples end on December 31, and we're talking about a year. This one is only talking about a quarter, where we are given January 1 numbers, and we want to do updates based on after 3 months have passed. So when it tells us the equipment is depreciated $400 a month, and we're now in March, I don't want to just put $400 depreciation expense. I want to put 400 times 3 because it's been 3 months. So I'm going to want to debit my depreciation expense for $1,200, the 400 times 3 months, and credit my accumulated depreciation. Make sure you pick the right one. It's not buildings, it's the equipment. Okay, so hopefully that will give you a good overview of what to expect on this week's homework. As always, if you could like the video or add a comment if you enjoyed it, if it helped, that helps me to know if the videos are doing as intended. I'll see you next week for closing entries as we get ready to close the books in week 4.